Good afternoon and welcome to Nasdaq Trade Talks. I'm your host, Jill Malandrino, global markets reporter at Nasdaq. Joining me at MarketSite, we have Tom Ciccolella. He's the partner with the U.S. venture capital leader PwC. We also have Anand Sanwal. He's the CEO and co-founder of CB Insights, and they're going to give us some insight into the record deal activity that we saw in the third quarter. Tom, Anand, thank you so much for joining us at MarketSite. Tom, I'm going to kick it off with you before we get into the data. Tell us about the PwC U.S. MoneyTree report. What type of trends are you looking to identify?
Sure. We started the MoneyTree report back in 1995, so it's been around for over 20 years now. And when we first started the report, we're looking to find what's going on in the entrepreneurial ecosystem, right? And so we kind of gathered data from venture capitalists and find out, well, where are the new industries people are investing in, and who's doing that investing? And we've been doing that for the past 20 years, and we'll talk about a little bit of the differences between now and then a little bit.
So Anand, CB Insights provides the data for the report.
Yep.
Let's talk about that. Why do you think VC-backed companies based in the U.S., there was a big increase in funding?
Yeah, so what we've been seeing is a surge in what we call mega deals, right, or what other folks would call private IPOs. So these deals of over $100 million, which 5 or 6 years ago would be pretty uncommon, have become incredibly commonplace today, and that drives up funding totals in a big way, and that's what we've been seeing pretty consistently over the last few quarters, and Q3 was no exception to that.
Would you say that there's more deals or more money per deal but less deal activity?
It's definitely more money per deal, right? So the actual deal volume is actually declining, right? And so what we're seeing is people are putting a lot more capital into each investment that they do across stages, from early stage all the way through to later stage. You're seeing a lot more capital invested per round of company investment.
Why do you think that is? Are investors becoming more picky, or are they looking for specific sectors or deals that they want to focus in on?
Yeah, from our perspective and what the data is showing, I'm not sure they're being more picky, but I think they have access to more capital. So what I would tell you is what's happened in let's call it the startup ecosystem is that you have non-traditional investors in the ecosystem. So you have private equity funds, sovereign wealth. So it's not just venture funds investing in venture-backed companies, it's a mix of venture companies coupled with private equity funds and sovereign wealth funds, hedge funds that are kind of looking to diversify their portfolio a little bit.
Yeah, that makes sense. Everyone's looking for an alternative form of investment outside of equities and other traditional asset classes. But ag tech and auto tech, that saw the biggest increase, but tech was flat. Why did you see the big increases in ag tech and auto tech and traditional tech was flattish?
Yeah, so I think those are relatively still kind of more nascent sectors, and so a handful of big deals can sort of distort the total funding. So I think there's a company, Lucid Motors, that raised a huge round in the auto tech sphere, and so that ends up buoying the overall auto tech area. But those are both, in general, both really fast-growing sectors, digital health being another one. So there continues to be pockets of kind of momentum within tech overall, and those are some of the sectors that we're seeing a lot of activity.
But traditional tech has been more flat, right?
Yeah, and I think when we talk about tech, and I think one of the points of the report is to kind of flush out like non-traditional investments. Like if you looked at our MoneyTree report 10, 15 years ago, you wouldn't hear us talking about auto tech, ag tech, digital health, right? And so that is the point. So they're, like Anand said, they're in their nascent phase and they're growing. And so that could be the next X of tomorrow, and that's what the report is trying to flush out a little bit.
All right, and now Silicon Valley remains strong, and New York saw a sharp increase. You think it would be the other way around? In fact, is deal activity, is it mostly strong in those two regions, or are there other pockets within the U.S. that are strong or declining?
Yeah, I think it's those two pockets have been strong for quite some time. So if you kind of aggregate the data between, let's call it the West Coast and the East Coast, you're talking about 90% of funding across the U.S.
Right.
And in Silicon Valley, a lot of times what we like to do is take Silicon Valley and the San Francisco Bay Area, put that together, and that's a big part of the portfolio. But New York is come on strong, as well as the Northeast, because technology is everywhere at this point.
Right.
Founders are everywhere.
But the West Coast still has.
The West Coast predominant. If you look at the numbers, over 50% of investing is done in California to those companies.
Yeah, there's I'd say LA is another good hub. Massachusetts still, but yeah, New York and
for the healthcare, right?
Yeah, Massachusetts definitely has kind of lost its tech sort of luster, but healthcare and energy continues to have a lot of investment there. But yeah, the Valley and New York are your two epicenters kind of investment in the U.S., and the Valley, as Tom mentioned, disproportionately so versus any other market.
And what are you seeing globally? Funding, it saw a slight uptick, but again, deal count was down there as well. What regions are outperforming?
Sure. In terms of the way we look at the report, we have North America, which is essentially the U.S. We have Europe, and then we have Asia, right? And so if you look at those, let's call them distinct markets, Europe has been pretty flat for a few years now. The U.S. has grown a bit, but Asia in particular has taken off. If I look back, say 8 quarters, Asia was probably about $7 billion in deal flow. Now they're about 20 on a run rate. Yeah. And so there's been a lot of activity there, and it's both deals and dollars. They're up probably from 600 deals up to 1,400 deals in that 8 kind of quarter window. So as we look at the report, it's really North America and Asia. Deal flow down this quarter was driven mostly through the U.S. for the most part.
Do you think that trend is going to continue, where we have deal count down but dollar amount up?
Yeah, it should. I mean, I think investors are they're sort of firing fewer bullets and trying to invest more in each company, and they're trying to optimize for ownership stakes, right? And so a lot of VCs who used to do seed deals are I think they've realized how much work those early small investments are. They're like, I don't have time for this. I'm going to go just do bigger deals. And then you have corporates that just can't put in small dollar checks. Like they're going to go only write big checks. And we see that especially in China, right? Like there's a ton of unicorns being anointed in China regularly, but they're hundreds of $1 million round sizes. Like they're really, really big round sizes.
It was interesting because we were talking before we came on air that you thought 2015 could have been the peak. Are you surprised that you've continued to get this flow 3 years later?
In some respects, yes. I mean, yeah, and you can speak to this as well, but yeah, because that was the beginning of what's called this trend, essentially, right? So when you looked at the MoneyTree historically, $20–30 billion in a year was sizable. Now we're starting to see that in a quarter, and that was again driven by these mega rounds, but it has continued, and in many respects it's upticked from those days.
Yeah, I think in 2015 it looked like it might be the peak of the unicorn sort of era, because we didn't know where the money would come from. And then, as Tom mentioned, hedge funds, sovereign wealth funds, SoftBank effect, right? Like all this other non-traditional money started pouring in, and then that just was more capital for these companies. And yeah, there doesn't look to be anything that will stop it right now. Just more and more money keeps plowing in.
It's like we were saying before, the institutions are just looking for alternative forms of investment outside of traditional asset classes. But to wrap up, Tom, the evolution of the VC space, I'm sure you've seen quite a lot over the past decade or two.
We have. I've been in the Valley for over 20 years now, and when I got out there, that was the period at its pinnacle. There was $120 billion invested in kind of 2000 alone. But then it kind of dropped off because it was more traditional in who the investors were and where they're putting their money. So like I said, you might have had $20 billion invested in any given quarter, but now that's changed. You have non-traditional investors looking for different kind of returns. The portfolio companies themselves are not looking for liquidity events at this point in time. They're looking to grow their business at the end of the day, right? And so they don't want to clutter any more than they have to with regulation and the like. So if someone's getting cut a $500 million check, that's going to give them a bunch of runway to kind of keep them private a little bit longer.
Yeah. All right. Well, thank you both for joining us at MarketSite, and thank you for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.